developments with digital taxation with a focus on Brazil. My name is Carlos Toro. I'm a tax partner of KPMG Brazil, currently based out of London, where I support multinational companies investing in Brazil. Joining me today are Brett Weaver, partner of International Tax KPMG US, Renata Foz, partner of International Tax KPMG Brazil, and Henrique Palma, director of International Tax KPMG Brazil, and also Henrique de Conti, who is a director of our transfer pricing team in the São Paulo office. So let's start. We have a full agenda today, and I look forward to this presentation, but maybe before we begin, we need to review a few administrative items. We can see in the next slide. In order to get a CP credit, you will need to, it's required that all participants are registered, logged in, and take part in these online questions. The polling questions will appear on your screen during various sections of the webcast. You must respond to at least 6 out of the 7 polling questions and participate for the duration of the webcast to receive a certificate of attendance. You may submit questions by using the Ask button on the right-hand side of your media player. All participants will be on a listen-only mode. We will answer as many questions as we can during the Q&A session at the end of today's podcast. If we are unable to answer your question, someone from KPMG will reply via email. If you have any technical issues, please use the question mark button in the upper right-hand corner of your media player to access our help portal. You can also submit this through the Ask a Question box in your player. Now that we have covered the administrative items, let's get underway with today's program. So this is the agenda that we have for today. It's a very comprehensive agenda. There are a number of items, so in the benefit of time, we'll start right with our colleague from US. There is basically no doubt of taxation of digitalized business is the topic of the moment, international taxation. In today's webcast, we intend to provide the audience with an outline of the typical business models adopted by companies operating in Brazil. So it's most of our agenda is really focused on Brazil, but try to give some context about the latest updates on taxation of digitalized business from a global perspective. We have our colleague from KPMG US. So without further ado, I'll hand over to Brett, who will provide an update and such overview to you. So Brett, over to you.
Great. Thank you, Carlos. Appreciate it. I think you set the stage well. There's a lot of tax developments happening around the globe as it relates to digital business models. And we're starting with this slide just to illustrate something that in many instances is unprecedented in global taxation, and that is the proliferation of unilateral measures largely targeted at digital business models. And this map, it's probably hard to read on the WebEx, but the principal point I think you can see is a proliferation of these unilateral measures around the world, and it's everything from digital service taxes to new definitions of permanent establishments, withholding taxes that are imposed upon digital payments, etc. So the underlying message here in showing this map is that there is growing concern across the globe that there is a digital tax problem. And what is that problem? It's a view that digital business models are able to participate in market jurisdictions in many instances either without a physical presence or in many instances the local physical presence receiving just a mere routine return for the overall group's operations. So very zero to little tax being left in the markets is a real concern. And so, as we think about this problem, there is, agreement across the globe that there is a problem. And thus, that's the reason that we have the BEPS 2.0, as it's commonly referred to, right, the digital taxation effort at the OECD and members of the inclusive framework. And that is that they're trying to solve this digital tax problem. And to be precise, the challenges, the tax challenges of the digital economy are putting pressure on the existing harmonization of international tax rules. And thus we see a breakdown of that harmonization and so many of these unilateral measures taking place. So if I were to summarize the areas of agreement across the various governments in the world that are really driving this BEPS 2.0 process, I'd say there's four things, right? There's agreement that whatever solution that is put in place, it needs to move back to this harmonization or coordination of global consensus as to how to treat these businesses. Additionally, there's a view that market countries should get a greater allocation of profits from these types of businesses, these digital businesses, than they're currently getting under the current system. I think there's also agreement that a global minimum tax, which is part of the BEPS effort, the BEPS 2.0 effort, that all companies across the globe would be subject to a minimum tax, that also is a good thing and something they're moving toward. And the fourth thing I would put out is that there's general agreement that dispute resolution process should be improved. And so with those points of agreement, you'd think we could get to a global solution. But I think it's informative to see that this proliferation of digital services taxes is evidence that we've had a hard time coming to a global solution. And I want to just spend a moment on where these digital services taxes and these other unilateral measures stand, because I think it's informative as to where we can expect things to go with the further efforts around BEPS 2.0. So if we could go to the next slide. The next slide here just gives us a rough view as to the scope of the types of business models that current digital service taxes target. And again, this is a generalization because it's different from each country. But in general, right, these unilateral measures are taxing on a gross basis, so nothing to do with profits, just on transactions themselves. They're taxing, connection services, and you might think about that with social media, dating websites, gaming platforms, that type of thing. So those types of business models being targeted, internet search engines, which is everything you would expect, digital advertising, that type of thing, and online marketplaces, often referred to as online intermediaries. So marketplaces offering goods and services for sale between sellers and buyers. And underlying all of that is this idea that consumer and user data that is gathered through these platforms, to the extent that it is monetized, either selling the data, providing subscriptions to access, data, information, etc., that those transactions are also taxable. This is important because the DSTs are really reflective of where many countries view a concern around business models. And much of what has happened in the DSTs is informing the scope of the rules that the BEPS 2.0 initiative is trying to find political agreement. So if we could advance to the next page. In the next page here, as we see, these various governments around the world who are really driving this process of trying to find a unified approach to solving the digital tax problem and trying to establish a new set of harmonized tax rules for the 21st century. As we mentioned, there's really those 4 points of agreement across the globe. And so one of the questions we might ask ourselves, if there's agreement on what needs to be done, why is it so difficult to find a consensus solution? And as we know, there was originally agreement at the OECD and its participating members of the inclusive framework to find a solution early in 2020. That got pushed to late 2020. And recently, with their announcements with the blueprints that were released last month, the target date for a solution is now moved to June of 2021, with many members of the inclusive framework, including the EU, stating this is the last chance, right? If there's not a global solution in place by June, if there's not political agreement by June, that many countries, including the European Union as a bloc, will act on their own. So why is it so difficult to find agreement? I think this slide illustrates some of the concerns and showing why it is difficult. I'll just work from, counterclockwise in this slide. If we start with the United States position is that whatever the global solution will be to address the digital tax problem, it cannot just ring fence and target specifically big tech, because that's mostly targeting U.S. companies from a U.S. perspective. And it would attack the U.S. tax base. It would be an attempt to take some of the U.S. tax base. The U.S. also demands a repeal of all these DSTs, the unilateral measures. The U.S. wants improved dispute resolution, specifically binding arbitration, which is going to be difficult for many other countries. And at the end of the day, whatever these new rules look like, from a U.S. perspective, it needs to raise tax revenues. In other words, it cannot be a solution where the U.S. loses tax revenues. Now we move on to the market countries. Market countries, in whatever the solution looks like, right, they're looking for a reallocation of big tech profits, right? For these companies, they want to see more of those profits allocated to the markets. They also are careful and concerned about expanding the scope of the solution to cover what was known as CFB, right, or consumer-facing business models. The U.S. is pushing for that. They want a broad application of these rules to include consumer-faced business models, not just big tech. And then, of course, the global minimum tax is something that the markets are actually supportive. That's referred to as the globe taxes. And then the U.S. wants, the U.S. GILTI rules, right, the U.S. CFC inclusion rules to be grandfathered. And the market countries are largely okay with that as long as the U.S. agrees to really their position around Pillar 1 in many instances. And then we have the developing countries as we look on the right-hand side of this slide. And the developing countries are really after a meaningful share of this reallocation of profits known as Amount A. And they're also looking for a robust mechanism to ensure that routine profits are adequately compensated in these developing countries, and that's known as Amount B. And then lastly in this space, the developing countries are very concerned about mandatory binding arbitration to address tax disputes. Even though the U.S. and other countries want that, the developing countries are adamantly against it, making that very difficult. This is all further complicated by macro considerations, right? We have, market, countries are receiving significant political pressure from their voters to tax more significantly these digital giants. We have the European Union, who has its own timeline of demands as to when things must happen, which is complicating the process. And of course, all this is underscored with the global pandemic, which has put significant financial pressures on governments around the world dealing with the pandemic, with a need to raise additional sources of revenue, and many are looking to digital taxation to do that. And finally, the U.S. political election, which is still a bit up in the air, depending on who you talk to in the U.S., but even with a new administration coming in, it's going to take time for a new administration to put people in place in the Treasury Department to actually negotiate these transactions to lead to a political solution. So as you can see, there's many difficult issues to work through to get to a political consensus. Will we get there by June of next year, which is the target date? I guess we will see, but I think the take-home point is that regardless of whether there is a political agreement in June, much of these rules that we see around the BEPS 2.0 initiatives will live on in one fashion or another. Either we will have consensus in much of these rules about how digital businesses and consumer-facing businesses will be taxed, will become the new norm across the globe, or we will not receive political consensus, and much of the discussion in BEPS 2.0 will become the basis for laws to be enacted in countries that are doing unilateral measures, including the EU bloc, who has said that they will enact a minimum tax proposal and also a digital tax proposal. So I think that's what we have to look forward in 2021. And Carlos, I'll turn it back to you.
Hey, Brett, thanks a lot. It's very useful to understand what's going on around the world so that we can better prepare ourselves on what to expect in Brazil. So I think now we're good to go to our, let's say, Brazilian section of today's webcast. I believe the starting point of any analysis on the OECD proposals, at least from a Brazilian perspective, must consider that, Brazil is a developing country. It's a major recipient of foreign direct investment and also have a large consumer base. So I think Brett would agree that Brazil is clearly a user market jurisdiction. And if you think about expanded taxing rights as it's being discussed by OECD for the user market jurisdiction with respect to value created by those highly digitalized business, this is something that is certainly on the interest of Brazil, right? Given being Brazil a market jurisdiction. The thing is that Brazil has a very unique set of transfer pricing rules. And if we think that, OECD is proposing not only a new nexus rules, but also new methodologies of profit allocation, this could actually be welcome in Brazil if you think about that, and some of you may know that our rules, our TP rules, they do not follow OECD TP guidelines and the arm's length principle, or at least until Brazil joins officially OECD. So considering this framework, we believe a good way to start in the Brazilian section would be to give an overview of those Brazilian very unique type of transfer pricing rules. So I'll hand over to Henrique to provide an overview for us. Henrique, please.
Thank you, Carlos. Well, hello. I hope everyone is okay, well. It's a great pleasure to present this webcast today. Thank you very much for your time. Well, as Carlos mentioned, I will talk about transfer pricing environment in Brazil. So in this first slide, if you could please yeah. Okay. So in this first slide, I have summarized the main aspects of the Brazilian transfer pricing system. The list was actually part of a document that was released in 2018 after a joint project between OECD and Brazilian IRS regarding differences in our rules when compared to international standards. So with this list, we can certainly understand why Brazil is apart from this whole digital economy discussion, especially when we talk about transfer pricing. So as mentioned, Brazil is not an OECD member, and it is not following the arm's length principle. For this reason, as we can see in the list, Brazilian transfer pricing methods are set with fixed percentages. We do have predetermined margins, regardless of the functions, assets, and risks assumed by the company. The regulation is clearly focused on tangible transactions. Taxpayers are free to select the best method for the entity, even when not appropriated. So what I mean here is that taxpayers may select the method that results in the lower exposure for the company, when available, of course. And there's a lack of transactional profit methods, as well as a lack of guidance for cost contribution and cost sharing loans. So this is a general overview, and it is fair to say that Brazil has a unique safe harbor approach, that it is applicable for any taxpayer. So it doesn't matter the turnover of the entity, the functions performed, the industry, the rules are the same for any company. And what is the reason Brazil has adopted this type of rule? The main reason that has always been mentioned by the Brazilian federal revenue since 1996, and especially nowadays, is to have a simplified system. And it certainly makes sense to have this simplified system here in Brazil, especially when we consider the size of our country, the limited resources we have, meaning the limited number of IRS personnel, the difficulty to train these professionals to deal with transfer pricing, this complex transfer pricing based on the OECD guidelines, difficult in accessing comparables. Actually, this is a difficult every developing country is facing, among other issues. So the idea of the Brazilian IRS was facilitating not only the compliance for the company, but also facilitating transfer pricing. The problem is this approach is required for any type of activity. So Brazilian regulations may be very simple and straightforward for companies that are performing baseline activities, and it may be a good alternative. That's the reason why the unified approach is also proposing fixed remuneration in this case. But when local companies need to apply it for a more complex transactions, for example, a transaction involving intangibles, or even just a common service provision, the application of the rules are not simple at all. And taxpayers have a lot of doubt on how to do it, how to prepare it, and how local tax authorities will behave on an eventual loss. And of course, as we know, intangible assets and service transactions are the core of any digitalized business today. So jumping to the documentation requirement, the topic 2, We are commonly questioned about the local and master file, but it is not part of the Brazilian study. Instead, taxpayers should fill a special chapter of the Brazilian income tax return. It is very simple, very straightforward, with general information on the methodology, on the intercompany transaction performed. Finally, APA and MAP are not part of the day-to-day of the transfer pricing profession in Brazil today. The reason is APA is not even regulated. And even though MAP is regulated since 2018, taxpayers are not interested to request it because of the uniqueness of the Brazilian rules. And let's say a distant relationship between the Brazilian IRS and taxpayers. So this on this slide we can see that Brazil has a good relationship with OECD, and a question we hear a lot is, will Brazil ever change its regulation in the near future? So the good relationship between Brazil and OECD since the 90s. Brazil is a key partner since 2012. But probably the most important event happened in 2017 when Brazil has formally requested membership for the OECD. And as we can see in the last bullet point, 4 months ago, OECD and Brazilian Federal Revenue has issued a survey inviting taxpayers input on Brazilian transfer pricing alternatives for the future. So if we can move to the next slide, I'll just comment a little bit about this survey. It was very interesting because this survey is actually a good overview of the Brazilian IRS and OECD discussions since 2017, when Brazil requested the membership. Brazilian Federal Revenue has always defended the safe harbor system, as I mentioned, due to the simplicity and certainty. And the conclusion we reached by reading this survey is the intention to continue with the safe harbor model. The idea here is just increasing the level of detail of this safe harbor rules. What I mean is defining fixed percentages depending on the activity of the company as well as the industry. So it's very similar, I believe, to what's been proposed by the unified approach. So the difference in Brazil is that for complex transactions, such as those performed by highly digitalized businesses, IRS is suggesting the APA as a solution. So what I mean, in case the activities performed by the local company are not able to classify into the safe harbors proposed, the company will be obligated to file an APA. That's what the survey is proposing. Okay, so this was a very quick overview of the Brazilian transfer pricing environment. Please consider that this discussion has just begun here. We are also hearing rumors of a hybrid system in which taxpayers will be able to select between the safe harbor system and the OECD approach, but we are not expecting changes in our regulation so soon. So again, thank you everyone. Back to you, Carlos.
Thank you, Henrique. So now that we know the specifics of Brazilian transfer pricing rules, let's move on to the different business models that companies can adopt to operate in Brazil. As you see, Brazil already taxed by way of withholding tax virtually any payment coming out of the country. So with the exception of dividends, any service fees, royalties, software license, any payments that comes out of Brazil are already subject to withholding income tax. That's a very particular feature of our tax system, which differentiate Brazil from a number of countries because at the end of the day, Brazilian tax authorities do not care much about permanent establishment characterization because again, they already tax by way of withholding tax on a gross basis, the income derived by non-resident entities making business in Brazil. And here we have to make a distinction between B2B and B2C. Renata will be commenting later on, but just to anticipate, when we think about B2B business, non-digital and digital companies, they are already generally taxed by way of withholding income taxes in Brazil. So when they operate directly from abroad and they bill or invoice clients in Brazil, they basically are subject to withholding income tax already at source. And this is one of the reasons why a significant significant number of tech companies, of big tech companies, already have a presence in the Brazilian market. You know, if you think about the large companies, they are already in Brazil, and there are a number of reasons. One certainly is tax. There is also, you know, the fact that we have a very large market in Brazil, so the customer experience it's enhanced when you have a local establishment. So we tend to believe that there are a tax, a market, and a regulatory, let's say, incentives for onshoring your activities in Brazil, and that's something Renata will better explore in a moment. But just to complement, when we think about B2C, then it's the other way around. B2C, given the lack of clear regulations, it's very common that certain type of payments actually can be made in Brazil without any income taxation, typically credit card payments. So whenever a foreign company is providing their offerings in Brazil and they are charging through a credit card mechanism, this typically, you know, get away or get around any taxation that happens in Brazil. So that's an important factor for any companies to consider. You know, if you are engaging in B2B and B2C, the outcome of your tax analysis in Brazil might be different. But Renata will be giving us some further insights on that. So she'll explain basically the different business models that, you know, foreign companies can adopt in Brazil. So Renata, please, over to you.
Thanks, Carlos. We will discuss three main alternatives to explore the Brazilian market. The first alternative that we will discuss is the provision of service abroad that is explained in the following slide. Carlos, if you could please, okay. So in this alternative that the services are provided abroad, there is no physical presence of the company in Brazil. So in principle, this structure is usually the first option to be analyzed by the company. Since when they are planning to start a new business in a country, they would like to replicate their business model to Brazil as well. But as we will see, and as Carlos mentioned, when we analyze B2B transactions, this structure is not efficient from a tax perspective, since it has a bunch of different taxes. The payment of the service would be subject not only to withholding tax, but also to other taxes. And the tax burden of the transaction could reach up to 40%. And some of the taxes that are triggered on the service, as the withholding tax and the service tax, the ISS, they are withheld upon the cross-border payment. But the other taxes that are levied, such as CG, fiscal fees, and IOF, they are borne by the Brazilian customers, which usually represent a huge cost for them. Therefore, assuming that in a scenario that the withholding tax and the ISS can be creditable to the foreign company, the main tax burden of the transaction is borne by the Brazilian customer. But on the other hand, if the service is not provided by a Brazilian company, it would be possible to avoid this taxation. So as you see here, the main issue of this structure, which is the provision of service from abroad without having any physical presence in Brazil providing the service, is the high taxation imposed on the import of service, which increases the total cost of the service and may even jeopardize the transaction because the Brazilian customers would generally prefer engaging a local service provider. It's important to note here, as Carlos mentioned, that the impact of this taxation, the 40% taxation, does not apply to B2C transactions. There is a lack in the Brazilian legislation, which does not regulate this type of transactions. So usually B2C transactions are not subject to any type of withholding tax, but only to IOF tax at 6.38%, which applies on payments made through international credit cards. So as you can see here in this structure, the issue is related to B2B transactions. And with this situation, the companies, they try to analyze different alternatives to reach the Brazilian market and have a more favorable taxation in Brazil, as we'll see in the next slide. So here, as an alternative to reach the Brazilian market without having a physical presence in Brazil, we see a lot of companies using a payment service provider, a PSP. The PSP will process the payment received by the customer and will remit to the foreign company. And one of the main advantages of this alternative is that the customer can make the payments in Brazilian reais to a company in Brazil, which is the PSP. And the foreign service provider should not be located in Brazil to receive the payment. Usually, this type of arrangement is only subject to IOF tax at 0.38% that is triggered upon the remittance of the funds to the foreign supplier. But at a first glance, this scenario seems more attractive since it seems that it eliminates all the taxes triggered in the import that we discussed in the first alternative. Because here you can say that there is no 40% taxation and only the IOF tax at 0.38%. However, there is a lot of debate related to the taxation of this business model, because there is no clear regulation on the taxation applicable to this kind of arrangement. And in principle, a customer in Brazil, if you see, is still importing a service. And as a result, the taxation should apply accordingly. So the fact that the payment is being made to a local company in Brazil should not eliminate the whole taxation. But in practice, what we see in this type of arrangement is only the payment of the IOF. And in some cases, we also see the withholding being withheld from the payment, because the bank is liable to check the payment of the withholding tax. So sometimes it's not possible to make this payment without the withholding tax being paid. So from a Brazilian customer perspective, although this type of structure simplifies the whole process and avoids the execution of a foreign exchange agreement to remit the funds, it's important to analyze carefully the impact of this structure, because as I mentioned, it is not clearly regulated in the Brazilian tax legislation, although a lot of companies utilize this type of business model in Brazil. So let's move to the next slide, please. Here we will discuss the reseller model. So due to the tax burden imposed in the import of service, which could reach up to 40%, the current structure is widely adopted by digital companies to invest in Brazil and reach the local market. So as Carlos mentioned in the presentation, taxation is one important factor that the companies consider to set up a company in Brazil to reach the market. So because of the high taxation, a lot of foreign companies, they establish a subsidiary in Brazil to provide the service locally. So the Brazilian subsidiary would act as a kind of reseller. And differently from the first alternative that we analyzed, in this model, in the reseller model, the overall tax cost of the transaction would be reduced from a customer's perspective. And this is why I usually prefer to engage a local supplier. Because in the first scenario, the customer is responsible for most of the taxes. And in this model, the service provided by the Brazilian sub, they would be subject only to corporate income taxes at 34%, and also to indirect taxes, such as gross revenue taxes and service tax, which are paid by the service provider. And the profits could be repatriated through dividend payments, which is currently not subject to taxation. But the issue that we have here is that usually the IP, the platform, the know-how, they are located abroad. And the foreign company should be remunerated accordingly. And the question that arises here is how to remunerate the foreign company in a tax-efficient manner. since we saw that the import of service is highly taxed. So, for instance, if the Brazilian sub pays a service fee to the foreign company to remunerate the know-how, the platform, this structure will not be tax efficient at all, since we will be transferring the tax cost that was borne by the customer in the first scenario to the Brazilian sub. So as we see here, it's important to understand that in this transaction, if we don't structure the repatriation in a tax-efficient manner, we will be transferring the taxes imposed on the service to the Brazilian sub. So therefore, it's important to analyze some repatriation alternatives to minimize this impact and make this alternative efficient. So now I hand over to Carlos.
Indeed, I think you mentioned probably the most relevant topic that we need to address here. I think, as you well explained, based on our experience, we've seen quite a lot of companies, not only large companies, but some medium-sized, companies in the digital space, setting up a presence in Brazil to try to deal and tackle this issue of the high tax burden that we have on cross-border payments. So that has been to a certain extent a trend in the last few years. To the extent that the Brazilian market is a relevant one for some players, they tend to consider setting up and establishing a presence in Brazil. And, it's a good idea at the first stage, but then the next question that comes up is precisely the one that you mentioned, Renata. How do you extract cash from Brazil? How do you repatriate? How do you compensate, let's say, the foreign group company for the IP, for the know-how, for the licensing of patent, for the technology that is embedded in the offering? So this is something that we've been dealing with a number of clients, and I think it's a good timing for you to maybe give some further insights of what we've been seeing in the marketplace and what companies are doing to try to address this issue. So if you could just provide us some further comments on the repatriation alternatives, that would be good.
Yes, of course. So currently there are some options in Brazil to reduce the overtaxation, but today we will focus on two options. The first option that is in this slide is the royalty payment. So to the extent that the Brazilian company provides sales functions to a specific market or region, for instance, to Brazil or Latin for its headquarters, it would be possible to remit part of the fees as royalties to exploit the Brazilian market. And the benefit here is that the payment of royalties is usually subject to a lower taxation if compared to service fees. This type of royalty payment could be subject in principle only to withholding tax and IOF tax. So we see here a good chance to lower the nominal tax burden for those type of income to 15.38% instead of 40%, which is the case of the service, because we can eliminate some indirect taxes on the payment of this type of royalty. And in addition to that, considering that this royalty would not be related to any kind of know-how and technology, because we are just paying a royalties for the right to exploit a specific market, it would be possible to say that this would not be subject to some deductibility limitations that apply to royalties. Because generally, royalties related to technologies, they need to observe some limitations to deduct the payment. But in this case, we are saying that we are not paying a royalty that is related to a technology. So in this case, we should not observe this specific limitation. Another important remark here is that in order to take the deductibility in Brazil, the payment must not be made to the direct shareholder. It should be made to an indirect shareholder of the company. Otherwise, the royalty payment will not be deductible in Brazil. And the payment should also observe the TP and general deductibility rules. So this is one alternative that we see some companies implementing in Brazil as a way of repatriating the funds instead of paying service. But of course, when we talk about Brazil and tax planning, it's important to highlight here that the Brazilian tax legislation often provides room for different interpretations. So any cash benefit that we can have from these alternatives should be carefully assessed prior to the implementation of a royalty charge, for instance. So let's move to the next slide, please. Another potential alternative that we see that aims at reducing the overall taxation on repatriation of the funds is the contribution of the IP. So in this scenario, instead of paying a royalties or a service fee, the foreign company would sell or contribute the IP to the Brazilian sub. This structure would be structured as a kind of usufruct agreement where the foreign company grants to the Brazilian sub the use of certain Brazilian market IP for a certain period. And again, one of the benefits of this structure is that it's possible to minimize the indirect taxation on cross-border service, because in this case, there would be no payment for the service. There would be only the payment for the IP if we acquire the IP. So in this case, there would be only IOF tax at 0.38%. And it's also possible to discuss whether the withholding tax and CD would be triggered in this sale. And in case of a contribution, it's also possible to discuss whether the withholding tax and CD would be triggered. So we see an important benefit here upon this contribution or sale of the IP. And the benefit that we see, besides avoiding the minimization of the taxes charged on the service, is the potential amortization of the IP in Brazil. So it would be allowed to amortize the IP for corporate income tax purpose, provided that the Brazilian sub has a report attesting its useful life. So as long as we have a report attesting the useful life, it's possible to amortize the IP during the useful life. And we could have a deduction at 34%. And in this case, we will not have payments for the royalties, would be only the payment for the IP or the contribution. So there is no limitation imposed in royalty payments that we have in some cases that we mentioned. So if we are talking about a royalties for a technology, we may have some limitations. And in this scenario, we can avoid this limitation. So this structure can bring significant tax benefits. But of course, again here, we should carefully analyze the implementation of this structure. Because if, for instance, instead of paying at once the IP, we decide to make the payment in installments or make the payment on an annual basis, this type of payment of structure could be recharacterized as a prepayment of royalties. And in this case, a different taxation would apply. So what we want to see here is only a contribution of the IP that we can amortize during a certain period, take the deduction, and we could remit any remaining profit as dividends, for instance, because there is no withholding tax on dividend payments, and there is no need to remunerate the company as a service because the IP is already in Brazil. So this is what I have from the repatriation. So I hand over to you, Carlos, again. Thank you.
I think it's been quite useful, and I hope every one of you managed to get a grasp of how, the different options available for operating in Brazil. I think the key message, as Renata pointed out, is really that if your offering to the Brazilian market is regarded as a service, that would attract a high tax burden. So that's why what we've been seeing with some of our clients is that companies are looking for alternatives to compensate the foreign company in order to avoid a typical service fee charge. So some of the options are the ones that Renata described. And as she mentioned, I think a proper analysis, a proper assessment needs to be made, and also a proper modeling exercise to understand the different tax implications, not only in Brazil, but outside Brazil as well. It's always relevant. And also keep in mind that maybe one of the features of the Brazilian tax system is really the high amount of tax litigation that we have. So unfortunately, this is very common in Brazil. Not only litigation initiated by the taxpayer, sometimes taxpayers are questioning or disputing certain tax positions from tax authorities in courts, but also we have a lot of tax audits going on and a lot of tax assessments. Unfortunately, it's something common in Brazil. We don't have much room for APAs or rulings, as you can see in Europe or in the US. And also, if you consider that in Brazil, the standard penalty for an under collection of tax for federal taxes is 75% of the unpaid tax, which is a quite high penalty when you think about other jurisdictions. So this is just to give you the message that if you are considering alternative, models or any options, a careful analysis is always advisable because, again, this tax litigation environment that we have in Brazil. But, as I said, some options are being discussed, they are being implemented by a number of players in Brazil. And now I'll turn to Brett just to comment of what is his view on the potential tax implications or red flags or issues that you can come across in the U.S. when you start to consider different, compensation alternatives to repatriate to the U.S. Brett, if you could give us some insights on that.
Sure, Carlos. Thank you. And, I really love the presentation because I think it very succinctly shows the options that most U.S. companies, consider here, as Renata laid them out. And, as you walk through it, you would, if you look at the base case repatriation that Renata put forward, right, that in that case, you really have the Brazilian entity earning all of the profits related to the business, with it just dividending those profits back to the U.S. That has a number of problems from a, U.S. investor perspective, and I'm sure it's the same with other jurisdictions that might be the investor jurisdiction. One is that, if the Brazilian company essentially earns all the profits, some of those profits are related to intangibles, technology and other things, as you mentioned, Carlos, that are probably owned in the United States, and there's no payment for that. And so it creates some risk that there should be a payment in the United States for the use of that intangible property by the Brazilian, group member. And so that creates a tax risk there. And not to mention, it's just expensive, right? As you pointed out, the profits earned by the Brazilian company taxed 40%. That's very expensive. So it does seem that, having the Brazilian company compensate, the U.S. for some of the intangibles through a royalty makes a lot of sense, right? It would leave less profit in Brazil to be taxed at 40%, right? And I think as Renata walked through that, the taxes on royalty payments, are a lot lower than 40%. So you basically, achieve some pretty significant tax savings. The issues with that one, however, and this gets back to Renata's point, you really need to do some modeling on all this stuff, right, is the point she made about what's the royalty for, right? Because if it's for access to the market, et cetera, then there's no limitation. But, sometimes it's, I know a lot of U.S. clients are concerned that the royalty could be viewed by the taxing authorities as at least in part, payment for technology. And therefore, the royalty could be limited to a certain percentage of sales, which creates some risk in that transaction, right? If the adequate compensation is much higher than, say, 5% of sales, and is treated as a royalty, right, the excess payments that are non-deductible, which also creates some tax risk. And that then leads to the other point, right? If you can't really use an arm's length royalty because there are limitations, can you essentially contribute the intangible property and amortize it over time so you could, reduce the Brazilian tax base through amortization instead of royalty expenses? The concern with that, and many jurisdictions are the same, is the contribution of that right to use the IP can be taxable. So if there's a significant value in that IP, it could trigger a large taxable gain by the U.S. shareholder contributing that IP. That can also be problematic. And lastly, I would say, in all these cases, there's uncertainty that creates concerns around the financial statements, right? Do you reserve for issues about the limitations on deductibility for royalties? Alternatively, do you reserve for the ability to take full amortization if IP is contributed? So it does create some uncertainty that companies need to work through and decide whether there needs to be tax reserves put on the balance sheet of the U.S. shareholder. So there's no simple answer. All of these are great options and alternatives. And as Renata said, working through some modeling to really find the right answer of these various options is what's really important.
Well, thanks, Brett. Very useful. So I guess, that was a summary. Of course, there are a number of details that need to be minded when you're thinking about implementing a structure like this in Brazil. But basically, now that we have the summary and the pros and cons of the different business models that companies may choose to operate in Brazil, maybe it's time to highlight some local tax disputes or local tax issues that impact digital business companies here. As I mentioned before, there is extensive litigation in Brazil on certain tax matters, and one should be mindful of these potential tax disputes. Actually, in fact, one of the leading cases involving a tax dispute for software taxation was finally resolved a couple of weeks ago after 20 years. So it's been pending a final decision from our Supreme Court for almost 20 years, and it's been finally sorted out. So it's something that it's always important to at least give you some overview of, the local tax disputes that we come across here. So I'll hand over to Henrique to provide some insights on those disputes. So Henrique, please.
Thank you, Carlos. And I mean, I don't usually like being the last one to speak in webcasts and webinars, but in this specific case, I think it's good because of what Renata, Brett, you, and Conti mentioned. I think maybe my life is a little bit easier to try to give a whole overview of why there is this amount of litigation or disputes that you just mentioned. But you're right. Even companies in the digital economy should be aware of that because they are indeed subject to, or may be subject to, legal disputes here in Brazil. Being one of the main topics of discussion, the conflict between ISS or ICMS, or in other words, if a specific transaction should be subject to ISS or the ICMS. And of course, for those of you that are not 100% familiar with it, ISS is a municipal tax levied on services, and ICMS, on the other hand, is a state VAT type of tax. And of course, we could expand our discussion here to other taxes, for instance, PIS and COFINS or CID, just mentioned by Renata. And actually, CID is another tax that leads to very heated discussions on whether specific transactions should be subject to CID. But conscious of time, let's just focus our discussion here on the conflict around ICMS and ISS. Actually, two weeks ago, we launched in the context of our webcast series, we held our webcast around supply chain, and there we mentioned, briefly touched upon the tax war that goes on among states here in Brazil. And when we bring that reality to the digital economy, we may not necessarily have a tax war going on among municipalities and states, but this dispute for additional sources of revenue, actually, it's another representation of how keen government is for these new sources of income, of revenue. And actually, this contributes a lot to this level of litigation and disputes that we see here in Brazil. And to be really honest, as you mentioned, as you pointed out in your question, this is not something new in Brazil. If we go back to the 90s, for instance, this discussion around ISS and ICMS was already going on. But of course, back then, the industry was not so well developed. The digital economy was not so well established as we see it nowadays. So the discussion was more limited to one or two subjects, and one of them is the one that was the topic of this judgment before the Supreme Court that you just mentioned, whereas software licensing should be subject to ISS or ICMS. Nowadays, because of the fast pace in which the industry has developed, of course, We have different offerings, different operating models, different businesses, and along with it, of course, the amount of tax topics that we have to deal with have expanded along with the industry. And just to comment on what you mentioned, because this is indeed really important. I think it was last week or 2 weeks ago, there was this judgment before the Supreme Court of Justice here in Brazil. It's still pending a final decision, but you can see that the justices are leaning towards a decision that seems that they will agree that software licensing should be subject to ISS. But again, we still need to see what the final decision looks like. So going back to our topic here, what makes our discussion even harder, and again contributes to this level of dispute that we see also in our industry, in digital economy, is the fact that, as I mentioned, the industry has developed extraordinarily in the latest years, but unfortunately, the legislation did not. So we as tax advisors and the industry itself, we still have to try to come across different setting of models. As Renata mentioned, we have different alternatives by means of which tech companies can explore Brazilian markets. We have different offerings, different nature of products, different transactions being carried out by tech companies, but still we also have the old tools that we had a few years ago to try to come across these challenges and come up with an appropriate solution for that from a tax perspective. And one last comment that is important to mention. I don't want to say that there has been no development whatsoever as far as legislation is concerned, because if we look back a few years ago, for instance, we could be talking about some transactions in the industry, for instance, streaming, that were subject to no indirect taxation. I mean, there could be no ISS, neither ICMS. And conscious of that, states and municipalities, since they were aware, they become aware that they were maybe losing some source of revenue, they both adjusted their legislation, but unfortunately, in an uncoordinated fashion. So that nowadays, we moved from a scenario where we had a specific transaction that could be subject to no taxation to a scenario where we may have a specific transaction business or offering subject to two taxes. So all those complexities add to our system here and may lead to this level of litigation and disputes that we see nowadays in Brazil. And maybe one last comment, what may be the icing on the cake, as I have mentioned already, is the fact that the legislation does not develop as fast as we would like to see it developing. So all of that together contribute for this level of dispute. And again, just to emphasize what Renata mentioned, that's why it's so important to take a proper look at the setting of the alternative that will be put together for the Brazilian market to be explored, because we have all these variables that together makes it a little bit difficult for us to come up with a proper conclusion on what we are talking about. So that being said, Carlos, I'll just hand it back to you.
Henrique, I think those are really relevant, insights. And what I typically tell my foreign clients, and I think it's important that everyone, keeps in mind, is that Brazil being a civil law country, we do care a lot about legal characterization of, transactions. So whatever offering is being made to the Brazilian market, for us, it does make a difference if we're talking about a service fee, a royalty, a software license, copyrights. I know that in many countries, because of, a much simpler indirect tax system where you have a single VAT, this is not so much relevant. But in Brazil, given that Brazil is a federation and we have taxes at federal, state, and municipal level, as I said, proper characterization is really key, and it does make a lot of difference when you're assessing any, the taxation of any transaction. So basically, the starting point of any tax analysis is really what is the underlying offer, how can we regard and characterize this offer? And that was pretty much what was behind between this dispute between municipalities and states in Brazil that basically were willing to charge simultaneously two different taxes on the very same transaction. So this is something very important for Brazil. And again, depending, and as you know, as the digital economy includes so many different offerings, you can think about software as a service, cloud computing. There are different, features and characteristics of those offerings. Those need to be properly considered when you are defining what is the appropriate taxation in Brazil. But I think moving on, I think we are approaching the end of our session today, but maybe the last topic is really to discuss a potential tax reform that we might have in Brazil. This is being discussed actually forever, but maybe for the first time there is some, indication that there could be a tax reform indeed in Brazil. One of the, as I mentioned before, one of the sources of complexities of the Brazilian tax system had to do with our indirect system, that we have multiple taxes charged by multiple levels of the government, and this has always been something that has not been helping to boost the economy. So in an effort to make Brazil more attractive to foreign investors, this government is really keen to pass a tax reform, and it seems that the states managed to achieve some level of consensus. So it seems that we might have a tax reform in the near future. So I'll hand over to Henrique to comment what he expects in terms of the developments that we might have and what could change in the landscape for the next year. Although I know it's hard to give a guess, there's actually a saying from a former Brazilian ministry that said that Brazil is a country where even the past is uncertain. So I know it's not easy to ask what we can expect for the future, Henrique, but if you could give us some of your insights, that would be appreciated.
Okay, thank you, Carlos. And when I was preparing for the webcast, I was just trying to recall exactly who said that you just mentioned, but thank you. It was a former minister, so that's good to know. But you're right. Tax reform, as you mentioned, despite the fact that we've been discussing tax reform forever here in Brazil, it's still a very relevant topic because depending on how it goes, not only the industry in the digital economy should be really impacted, but the industry as a whole. But before we jump into the different proposals that we have on the table, let's just set the stage a little bit here. Here in Brazil, we have three different levels of jurisdictions. We have federal, state, and municipal levels of jurisdictions, each one with their specific tax. Some of them levied on services or goods. So we are talking about different levels of the administration with different tax, a bunch of taxes, different taxes here in Brazil. And all of that adds to our system and makes it unique, if you will. And so when we talk about tax reform here in Brazil, we're not necessarily talking about a change that will result in an increase of the tax burden or a reduction of the tax burden. But the main idea, I think, behind it, mainly taking into account the proposals that we've been seeing, is that this tax reform or a specific bill should result in more simplicity to our system. More simplicity that actually would contribute for a reduction of the tax evasion and a reduction of the level of litigation that we see nowadays. So that's the main idea behind a tax reform. If that will become true or not, we're still to see, but that's what's being said, and actually that's what we've been seeing with some of the bills that we have on the table. So that being said, if we look at this line here that we have on the screen, we are talking about different proposals, different bills. We have what we refer to as a broad constitutional reform, which are represented by PEC 45 and PEC 110. And we have what is referred to as an infra-constitutional reform, which basically refers to specific views of law that basically tend to be simpler than the first one, mainly because the first ones would require an amendment of the federal constitution, whereas the second one would basically require a complementary or an ordinary law to become valid and enforced here in Brazil. And in addition to these proposals that would be within the context of a tax reform, we would also have some proposals, some bills that would be focused on the digital economy sector. So it would be more specific to our industry here. And in the next slides, we would try to touch upon the specificities very briefly of each one of those different bills. So thank you. In this slide, we can see Tax 45. Of course, it has several different provisions, but the main idea of this proposal would be indeed to simplify the system, the tax system here in Brazil, and how it would be achieved. Basically, we would substitute 5 taxes that we have nowadays: federal, state, and municipal taxes, which you can see right here on the right top corner of the screen: IPI, PIS/COFINS, ICMS, and ISS. The idea is that those 5 taxes would be extinguished or merged altogether for the creation of the IBS, which would be a federal tax divided on specific goods and services. And in the next slide, we can see PEC 110, and basically this PEC is somehow similar. I mean, the idea of this proposal is similar to 45, but this one will be a bit bolder than the first one, if we may say so, because if we look at what's the main idea behind it, it would also contemplate the creation of another tax, IBS, also a federal tax divided on specific goods and services. But for that creation, we would have to extinguish 9 different taxes instead of 5. So again, another project that indicates that indeed the main idea behind a reform is to contribute to the simplification of our tax system here in Brazil. Finally, if we move to slide 30, we can see the bill 3887, which is the most recent one that has been presented. This one has been presented by federal government. And again, just to remember, this one is not a constitutional reform. This one is a little bit, should be at least a little bit simpler. And the main idea between this one, also targeting at simplifying the Brazilian system, but that only contemplates the extinguishment of 2 taxes, or actually 2 contributions that we have nowadays, PIS and COFINS. And PIS and COFINS would be therefore extinguished, and CBS would basically replace these 2 contributions. CBS would be a federal tax, also charged on a non-cumulative basis at 12%. So instead of all those different taxes that we have nowadays in what comes to PIS and COFINS, we would have only CBS as a general rule, charged at 12%. Of course, there would be a few exceptions to some specific industries, but the idea is that the 12% rate would apply to the vast majority of industry. And another specific comment here that is important to the tech industry, and that differs from the previous one, is that although this project is focused on extinguishing PIS and COFINS as a general rule, it has a specific provision that concerns the digital sector, which is basically the fact that it brings a provision stating that digital platforms could be responsible for the collection of CBS on specific circumstances. So we will talk about that in more detail in a few minutes. So those are the main bills that we have on the table. We're not sure when or if they will be approved, but they clearly indicate what is behind, what's the idea behind the tax reform. And one may ask, okay, we have these 3 different bills, but how can the industry, how can the digital economy in Brazil be impacted? And here we can talk about four different potential impacts. First one, as I mentioned in the beginning of my presentation here, one of the sources of dispute is the conflicts that we have between different taxes, for instance, ISS and ICMS. With the extinguishment of different taxes and the creation of a single one or at least 2 different taxes, there is a likelihood that this dispute between different levels of government will come to an end. So there should be no disputes in regards to which taxes should be levied over which specific transaction. So that's a positive message. That's a positive outcome that we should see in case this bill passes as they are today. But unfortunately, not everything is a good message. On the other hand, if it passes as they are today, we may see an increase to the overall tax burden that companies are subject nowadays. And why is that? Because nowadays, if we consider PIS and COFINS, when we are talking about indirect taxation only, the overall tax burden may range from 5.65 to 14.25% on revenues. the derived from the offerings. If we look at one of the projects, for instance, this total burden may reach 25%. So that's bad news for the industry. Again, we are not saying that that's actually what's going to happen, but it's what it seems. It's what we have nowadays to work with, and the message here is not that good. A third potential impact to the industry refers to where taxes should be collected. Because nowadays, basically, when it comes to paying ISS, for instance, ISS should be collected on the jurisdiction where the company is resident or where the service is provided. And when we look at one of the projects, for instance, there is a likelihood that it will be shifted to where the customer is located or where the offering is being utilized by the customer. So that may result in additional work for companies in terms of compliance, and also the legislation as they are today, they are lacking specific provision as to how that would be determined. How should I determine where the offering is being utilized? So that's something that we would like to see more details on. And finally, one additional potential impact to the industry is in respect with what we have already mentioned, the fact that some of the projects, or more precisely Bill 3887, it brings specific provisions held in digital platforms liable for the collection of taxes. So again, a lot of if that passes as proposed today, it may result in additional work, in additional need for compliance by tech companies. So that's basically what the main outcomes that we foresee should those bills pass as they are today, Carlos. And if we can move to slide 31, I guess, or 32, sorry.
Yeah, maybe on that point, Henrique, indeed, when we are compared to what's going on in the international scenario, clearly we can see those digital services tax popping up in many countries as sort of a reaction to the lack of consensus. And as we discussed before, in Brazil, we already impose a number of taxes on a B2B setting, a cross-border payment. Brazil already imposed consumption taxes and also income taxes, because there's also this distinction in the international scenario of, countries taxing the income of foreign providers and also certain consumption taxes being put in place. And again, in Brazil, in the B2B scenario, we have a lot of taxes. Just if you look from a certain perspective, Brazil was in the forefront of that and already implemented some of those measures. But as we also mentioned, in the B2C, there is a sort of a loophole in the legislation that the government is not being able to, let's say, impose any relevant taxation on consumers. So there is this perception in the government that this international discussion could also be useful for Brazil, because there's clearly a significant amount of transactions that are falling out of scope of taxation in Brazil. And so I think the last comment that we can make on this, there has been some time ago an attempt to create a new tax that would be focused on digital transactions, but that didn't move forward. But if you can just give us some comments on that.
Yeah. Thank you, Carlos. You were right, and this somehow is aligned with what Brad started saying, because when we look at this slide, and I anticipated that, we are talking about two different bills specifically targeting the tech industry here in Brazil. So the idea behind CID Digital and COFINS Digital would be that governments are willing to target revenues and profits derived by big tech companies in Brazil. And when we look at the explanation of the whys they are proposing these different projects, is because based on their understanding, these are aligned with what's been going on at the OECD level, or at least some non-OECD countries, in the sense that there are a portion of the revenues and profits derived by tech companies that are not being captured by any tax whatsoever. So the idea of CID Digital and COFINS Digital would be to try to reach these revenue that theoretically in Brazil are not being taxed. So basically what the idea is that some offerings would be subject to these taxes. So as we are outlining here in the slide, so advertisement via digital platforms, making the platform available for transactions with goods and services, or the transfer of data from users here in Brazil would be within the scope of those taxes. Digital, for instance, would be a tax levied on gross revenue at rates ranging from 1% to 5%, and the COFINS Digital would be a tax also levied on revenues, but at a statutory rate of 10.6%. So, of course, there are a lot of specificities in respect to each of those taxes, but the main idea, again, is to tax revenue derived by big tech companies doing business in Brazil. And again, when we read the reasons, the whys for these taxes, the government expressed that, okay, we need to be aligned with what's been going on in other countries. We need to create the so-called DSTs because we have revenues that are not being subject to taxation. And actually, this is a discussion that's been going on for a while now, also here in Brazil. But the missing part, what they may not be considering, is the fact that this discussion makes total sense when we look at the industry, because as Brett mentioned, because of the way the business works, a specific company may be deriving revenue in a specific jurisdiction without being physically present there. So there is indeed a chance that a specific portion of the revenue is not being taxed anywhere in the world. But when it comes to Brazil, that may not necessarily be true, because when we look at the way the tax system works here in Brazil, and as you pointed out before, and if we consider that the vast majority of the big tech companies are already established in the country, by creating Digital, COFINS Digital, you name it, or any other tax, what could happen actually is that we would only be adding an additional layer of taxation to the companies that are already subject to a load of taxes here in Brazil. So instead of contributing to an increase of the revenue for federal government or state or municipal authorities, we could actually be not contributing to attract business to the country. So again, these proposals are indeed aligned with what's been going on in the OECD, but not sure if they make sense here in Brazil, considering the way our tax system works. So basically, that's my comment on that, Carlos.
Well, thanks a lot, Henrique. So we are coming to the end of our session. I think we still have time for maybe a couple questions. One question that came up was related to the scope of taxation of CIDE. Not this one that Henrique mentioned, but the one that already exists in the Brazilian system. Basically, CIDE is imposed in any cross-border payment of agreements that involve technology transfer. So it could be technical assistance, it could be a patent license, it could be the supply of know-how when you pay for trademark licensing. So typically transactions that involve some sort of technology transfer are subject to CIDE, which is triggered at a 10% rate. And the taxpayer is the Brazilian paying, so the Brazilian resident entity that is paying a royalty or a compensation for a technical assistance service fee. Another question that came up here was actually directly to Renata. Renata, when you discussed the alternatives to explore the Brazilian market, clearly one option that stands out was the reseller model, which have been broadly used by large tech companies when operating in Brazil. The question is basically, what are the main advantages and or the difficulties that those companies face by adopting such model in Brazil?
Yeah, I think as I mentioned before, the main issue here is the repatriation. So because when the companies establish a company in Brazil to provide service locally, it's an efficient alternative to reach the Brazilian market because the taxation is transferred to the Brazilian sub. So the cost of the transaction will not be borne by the customer, as we see in the model that the services are provided from abroad. But here, what we have to pay attention is how to repatriate the profit. Because as you discussed with Brett, we don't want to leave the profit in Brazil and tax it by 34%. So we want to reduce the taxation and repatriate the profit. So in principle, we could repatriate through dividend payment, but in this case, we would not be reducing the taxable the taxable basis of the corporate income tax in Brazil. So we should find other alternatives. And if we pay service, we will end up in the same situation that we were in the first scenario. So we will be paying 40% taxation. So the issue here is that we need to find an alternative that works either from a Brazilian perspective and also from an U.S. perspective, because as Brett mentioned, if from a Brazilian perspective we can structure the royalty payment to exploit the Brazilian market, we need to understand if it is possible to structure from a U.S. perspective, because we need to implement a structure that has the same nature for both countries. Otherwise, it wouldn't work to have a structure that would be viewed as a royalty perspective from a Brazilian tax perspective, but it would be treated as a service or any other type of nature in the U.S. So this is, I think, the main challenge that we have when we structure a reseller model in Brazil.
Yeah, and if you allow me to add one thing, as you said, I think the idea that the foreign company would be supplying the offerings for free and that all profits would be built up in Brazil and, taxed, and then the Brazilian company would distribute the dividend is also typically not consistent with the transfer pricing profile of the companies as well, because as you said, typically when you have a reseller in Brazil, the functions and assets very often would be quite limited. So you wouldn't expect that, the bulk of the profits would actually be in Brazil. So it's also an issue of, the consistency in applying the transfer pricing policy of the group. So it's a complicated matter, and that's why, as you pointed out, it needs to be carefully considered. So I think we're coming to close of the session, and I'd like to thank those of you who submitted questions, those of you who raised any question that we have not been able to respond with. We'll do it by email later on. I'd like to thank everyone for attending today's webcast. We also have a feedback survey which should pop up on your screen shortly. So your feedback is extremely important to us. So if you don't mind, please fill out the form if you have a chance. I'm reminding that we'll be also distributing the webcast slides and playback via email in the next 24, 48 hours. So again, thanks again to all our speakers and as well to everyone who joined the webcast today. Thanks a lot and have a nice day.
Thank you.